Hello and welcome to today's episode of Nucleus Investment Insights. Today we're going to give an update on supply chain issues and ask if these problems have been resolved or whether they've merely shifted. On the agenda, we'll look at how shipping container rates have crashed since earlier in the year. Then we'll explore how inventories look to be full and are showing signs of reversing. Next, we'll delve into why the number of containers coming out of China has plummeted. New factory orders are also closing in on recession lows, and we'll also look at why there are indications of a reversal in used car prices. We'll also touch on manufacturing, energy, and inventories. And as always, at the end, we'll discuss the investment implications. My name's Sam Kerr, and I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen. Damo, welcome.
Hi, Sam. Thanks.
For scheduling purposes, we've recorded this yesterday. However, the live chat function is still enabled, and Damien will be here to answer any questions on the chat. So please do still ask questions as we go through the slides. And just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform as our show is available on all the majors. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these in the episode at nucleuswealth.com/webinars. So now we've got the housekeeping out of the way, I'll pass it over to you, Damien, to get us started.
Thanks, Sam. So the main reason for wanting to have a bit of an update on the supply chain is just over the last week or two, there's been a whole bunch of different announcements come out that potentially portend the end of a lot of the supply chain problems, and we just wanted to delve into them and try and work out, how realistic are these. So probably headlined would be the FedEx announcement from last week, where FedEx basically came out and said that they're looking at significantly lower sales and concerns about recessions and plummeting demand in a number of different areas, particularly in Europe and Asia. I think that it's probably and then there's a few there's a bunch of surveys come out which have sort of been showing that there's some significant downturns as well. I think for FedEx's side, it does appear for the moment that we've still got some of their competitors talking about not talking about the same thing. So it is potential that there are sort of FedEx specific issues. It's also potential that that they're just catching the earlier sign of it, and some of these other ones will also come out with similar announcements. But for the moment, I think we'd probably say that the FedEx stuff is it's potentially a sign of weakness in the rest of it, but there's enough doubt there to be too certain. And the other thing is, maybe what's happening is just the supply chain issues are being solved in some areas and being recreated in others. And so we wanted to sort of jump in and explore some of those issues for the moment. So I guess I want to start with these a couple of different scenarios which we spoke about. We've spoken about several times over the course of the last year or two as we've been talking about the supply chain issues, and we've got sort of two opposite ends of this in terms of one of them's the inflation boom side, and under that scenario we see goods demand remaining very high versus services. On the inflation bust side, we've got the goods demand reverting to trend. And it does appear that we're sort of more on that goods demand reverting to trend, although it has kept higher than sort of before the pandemic, but it hasn't sort of completely normalized that relationship, but it's getting close. And I think the expectation is more on that. We'll get a reversion. One side sort of says these supply chain problems they're intractable and they're going to last for years. The other side says that the supply chain is temporary. They've obviously lasted a bit longer than we certainly expected this time last year, but I guess in the defense I don't think there were too many people expecting that Russia and Ukraine would go to war, and that would then there'd be a whole range of sanctions and the flow on effects from those. So that's certainly clouding the issue as well. But we'll dig a little bit more into the supply chain issues because they do seem to be disappearing. They haven't completely gone back to the old levels in a number of cases, but I think the expectation for us is still that that's you have to revise your definition of temporary and sort of take into account that other factors might come in, and China's still obviously going through rolling sets of lockdowns that's slowing things down, but it does seem as if a lot of the main problems are being resolved. Under the inflation boom scenario, there's this idea that commodity demand is going to exceed supply for a long time. I think we've spoken long about our doubts for that, and it does seem to be. We've certainly seen that Chinese construction, which is one of the biggest consumers of commodities in the world, keeps falling in terms of that demand, and new starts are now sort of hitting the levels they hit in sort of the 2015 slowdown, but they're still well above levels where China first started talking about it being in a bubble and having unbalanced demand. So fallen a long way. It could certainly fall further. There's potential that China could reverse the whole thing and decide that they're going to throw a lot more money at building, but it certainly doesn't appear that way. And it also looks as if some of those prices have sort of put a real dent in terms of that. I guess the expectation for investors in Chinese property. And then you get this energy costs issue. Is that on one side energy costs remain high, and that's actually I think more likely in terms of given the situation in Russia and the Ukraine. I think if to get a real burst, a real sort of bust, you need these alternative sources to Russia to emerge quite quickly. China could continue to slow, and then the interest rates sort of biting and slowing down around the rest of the world, and potentially recessionary in a number of other developed markets, could actually see that those energy costs fall quite sharply if that happens. Now, I think for our expectation, we're a little bit caught on this one in terms of not being sure. I think there's certainly signs that we could be headed for a quite reasonable fall in terms of these energy costs, but there's all you'd need is a cold winter in this time around in Europe, and a lot of that might reverse, and you might see these prices go to new highs. And then finally, wage growth. And so we're certainly seeing wage growth in the US, mainly at the lower end, but elsewhere that isn't the case. You're not seeing, particularly say in Australia, Japan, Europe, you're just not seeing that same wage growth come through. And so need to sort of question, is this a global phenomenon that's just going to drive markets higher, or is there something specific to the US, and which way would that go? But anyway, let's jump into some of the different factors, because there's a Philadelphia Fed manufacturing survey. So there's lots of different surveys that come out in terms of looking at manufacturers in particular, and looking at what's happening in terms of prices and orders and all these other sort of factors. And the Philadelphia one is just one of many. But as it came out a couple of days ago, I thought it was well worth sort of jumping into some of the figures here, which are sort of showing that things have reversed. So the first one, I've got a chart up for manufacturing new orders, and you can see that's fallen sort of relatively deep into the negative territory now. So it basically hasn't been this deep since you had a brief moment during the pandemic, and then the last time before that was back in 2008. And so in terms of new orders for manufacturing, it's at recessionary levels already. If you jump into the prices received and prices paid in this same survey, so one side's what is so on the left is what are these manufacturers paying for their inputs, and on the right is the prices that they're receiving. You can see both of those obviously went through this massive spike in over the last 12 months in terms of the price, extreme prices, but they've both fallen back to what you'd sort of call, I guess, more normal, probably at the upper end of more normal levels. But there's certainly most of the heat has come out in terms of the amount of price rises and price that we're seeing there. And then finally, the delivery times. So, obviously, we've had a lot of problems with transport and extended delivery times. And you can see now from this survey anyway. And again, just noting this is only one survey in manufacturers in the US, but that's and it will vary by industry. But you can see that the delivery times have again plummeted. Whereas over the last year we went through this extreme sort of I guess a 20-year high in terms of the problems getting things delivered, whereas that's gone away and back to sort of even below, back to sort of the levels we saw in 2008, again at sort of recessionary levels.
And Damien, with these, coming back to more sort of, reversion to the mean, I guess, back to the sort of trend, is that the effect of interest rates going up, or what do you sort of attribute that to?
No, I think interest rates really haven't had enough time to bite for this to be interest rates. We spoke about last week. We ran through some of the figures in Australia and how the average mortgage, the average homeowner with a mortgage has only just started to see the first couple of rate rises. They really haven't seen the bulk of the rate rises so far, and the US is even more extreme in that it's affecting new homes, but it doesn't go into to affect the people who already started building homes and people who recently bought them. So for my part, this is more about that there were a lot of supply. So we had that whole goods versus services, an extreme amount of goods being bought. They sort of hit these traffic jams in terms of more goods was trying to be forced down the pipe than what the pipe could handle. And at the same time, supplies and transport was sort of hit by workers who are being sick, going off sick, and they'd lost a number of work. They'd laid off a number of workers at the start, and so didn't quite have the right the right staffing levels. And so that sort of all coalesced into this traffic jam, and now the traffic jam's starting to clear. And
it's just working itself out.
It's working its way through.
Yep.
Some of it is the goods demand. So that we're not shoving in as much in at the top of the pipe. So that's helping the bottom of the pipe to clear. The other thing is there's been a lot of developments in terms of what's just the technology that's being used in the supply chain. Talking to people who are heavily involved in the supply chain, they speak about how at the start of this there was still a lot of places that were faxing orders and that you needed to phone somebody to confirm receipt and bits and pieces like that. And just so they've gone through this part where they didn't have to modernize because everything was sort of working. To a lot of money being spent over the last few years in terms of really trying to modernize and streamline a lot of these supply chains. And so there's a pretty reasonable chance you'll get a snapback, and you will see prices fall even further. But the question is how long that takes. Will we go through a sort of double top, so to speak, as what we saw? That was what the next one I was going to jump on is lumber. That was one we sort of dealt with a lot last time. Sorry, actually, does that answer the question though, Sam? Before we go?
Yeah, it does. But I'm also curious, when interest rates are, when that does flow through into the economy, is that gonna
could make things a lot worse? Yeah,
that's right. Yeah. So
we're already at recessionary levels with only the merest hints of these interest rate, getting started. So it is entirely possible that central banks have overcooked it already. But we won't. And keep in mind these surveys that we're looking at. These are very much leading indicators. So you sort of, as you look through an economy, you look at the surveys and sort of current data for sort of the outlook type data. Now it's not always right, and it's less precise than some of the other data, but it gives you sort of a much faster read on the economy. Then you get the sort of coincident indicators, and they're the ones that sort of tell you, what's going on now, and they're a bit faster and a little bit more certain because they're less about what people are saying will happen or suggesting happened, and more about some of the faster numbers. So maybe things like credit card numbers and spending. And then finally, you get the sort of the final numbers, and that often come in quite lagged, but they're a lot more precise.
Yeah,
and
telling the true tale.
Yeah, and the problem is, though, we're not going to get those for 6 months. And if the economy is already in recession now, then if you wait for those indicators to come out and then go, oh, the economy is in recession, I better sell everything. It's like, well, the stock market reacted, 12 months ago to that. So you're too late. And so, a lot of it's trying to interpret what are these things saying. And I guess I'm wary in that we've been speaking about these pressures as not being pressures that will last forever, as being more on the transient and sort of transient inventory super cycles, and then morphing into another delay because of the Russian sanctions and the Ukraine war, and then finally everything comes through. And I guess that's what I'm positing now, is it looks like that's happening. I guess I do have that once bitten, twice shy sort of reflection in terms of, look, maybe something else will crop up. Maybe the droughts will cause more issues. Maybe we'll see more problems in terms of energy that cause other problems, that cause there's potential at the moment that Europe's going to be suffering some bigger outages due to gas problems because of the extreme gas prices. So maybe that'll cause more problems and another round of supply chain issues. But for the moment, and then I guess that's what I'm saying is, the ones we're looking at seem to be clearing. Maybe there's other ones cropping up from other issues, and that'll extend the inflation. But it certainly does look like they're starting to obviously all the indicators have shown it so far look like the problems that we saw over the last year are very much starting to clear.
Excellent.
Lumber prices is another one. So we spoke a lot about lumber prices. Now, this is largely driven in the US by home building, and these are US lumber prices. So they sort of went through this period where they traded at whatever it was, $300, $400 back pre-pandemic. The pandemic happens, they fall back sort of 20%, back to sort of 250, and then stimulus comes through, all these interest rates drop, and everyone wants to build a new house, and everyone's trying to get away from their apartments and can work from home more, and so need extensions and studies and all that sort of stuff. And so and that was where we saw that real rise up in that lumber prices and at the same time, the producers of lumber had often shut things down or laid off workers, and so when the demand came through, they were scrambling trying to get the workers back up and running, and maybe plants had shut down. Some plants they needed to reopen, or plants were running at part time, and then they needed back to run 24 hours. So we saw those prices shoot up to over 1,500 before crashing right back down again, not to the prior levels, but pretty close. And then we saw it take off again in sort of late 2021. And now it looks as if that's all come back to more normal levels. It's not quite to the old levels, but we're pretty close in terms of that. So and keep in mind as well, I've got another chart sort of popping up which is showing the volumes. So so this is actually looking at loadings in terms of the amount loaded into rail cars, and so that this 21-22 period where you saw prices go up 10 times and then fall back down again, or almost 10 times, that really wasn't driven by volume. So the volume of wood product is actually still really low. So it's not it's been more of a function of availability than it has. There's this massive new boom in terms of the amount of wood needed and all this extra capacity needs to come on. It's actually more about just sort of using the capacity that's actually there. Okay, so lumber's one area that's sort of showing that it's come back. One of the bigger ones as well has been used cars. Now, used cars, that sort of drove a lot of inflation over the last year, and the prices are still extremely high in terms of the used car prices. But I just wanted to flag there's a couple of things that look like they've turned pretty decisively down. One of them is the wholesale used car prices, and they take a little while to feed through into retail used car prices. So usually 2 or 3 months before you start to see the real effects. But I've got a chart up there just sort of showing this index in the US, and it's come off quite substantially off the top. It's still got a long way to fall to get back down to the prior trend, and that's sort of a lot of that is dependent upon new car sales, new car manufacturing, but it's pretty clearly turned and coming down. And the one that you that shows, I guess, an even more severe sign, and this is, sorry, I've lost the person who the broker that sort of published this one actually off this chart. And this is somebody just sort of showing that if you put the inflation in terms of new vehicles on one axis, and then you put on the other axis, you put the dealer's inventory upside down. And what you find is that there's a pretty decent correlation between the two. So when you're running out of inventory, then prices shoot up, and when you've got lots of inventory, prices fall. And as you can see from this chart, with a lag, with a 12-month lag. So as you can see from this chart, the blue line has plummeted. So there's lots of dealer inventory out there. They've got plenty of cars. Now it's a question of, well, will prices fall as they try and get rid of all the cars that they've got?
And Damien, wholesale used car prices, is that just dealers? Is that car dealers? Is that what you're referring to?
Yeah. Most of them, car dealers. Most of it would come through from a lot of fleet sales and things like that. And so they'll be the dealers buying these used cars at auctions and at fleet sales, and then once they've got them, then they slap a new coat of paint on them and then sell them at a markup to the retail punter.
Okay, understood.
Mm. Lumber looking like it's turning down. We've got all the manufacturing indices turning down. Cars is so it started to turn. It's not. It's I do want to highlight though that the used car prices are still really, really high, and we really haven't seen massive falls yet, but the signs do look like they're pointing towards continued falls. Shipping prices, so that's been one of the key I guess indicators people have been using to highlight how much the problem has been. I've got here probably one of the most used lines in the world, which is the Shanghai to LA container freight. And so you can sort of see on this chart, prior to the pandemic, it was about $2,000 to send a container from Shanghai to LA. And actually, if you look at containers going back the other way, and they're often usually the empty ones, that's sort of it's maybe $1,500 to send an empty one back has been pretty consistent over that whole time frame. Or $1,500 to send a container from the US back to China. But the rate from China to LA really rocketed as we had this massive increase in goods demand, and then the lack of ships to carry them all, and then traffic jams in terms of getting the goods out of the LA port. And so they sort of rose sixfold up to $12,000. That's been coming back quite dramatically over the last year, and in the last couple of weeks as well. We've just seen some huge falls in terms of the prices. So we've gone from 12,000 back to 4,000. So again, still double the price you would have seen prior to the pandemic, but certainly moving in that direction you'd be expecting. And then in terms of the number of containers, that's it's been a big fall in terms of the number over the last month. So I can't remember the exact percentage was might have been down 20% ish. That's not true of all the different ports. So there are differences, and some ports are still increasing and some are declining. But the statistics you're seeing out of China in terms of the number of ships and the number of containers sort of leaving a lot of the Chinese ports is down, and the queues are clearing, and subject to there's still the potential you might see industrial action in the US, which could bring the traffic jams back in terms of the ports. But at the moment, it does look as if all those volumes are starting to fall quite meaningfully. We've seen some of the bigger retailers sort of come out with profit warnings over the last couple of months, and a lot of it talking about having too much in their inventories. But that takes a while to actually filter through. So the orders that they, if a month ago you cancelled all your orders, then the effect of that cancelling it a month or 2 months ago is only just being what you're starting to see now coming through into LA, because you cancel it at the factory. The factory might take a week or two before it gets it to the port, and then the port might take 3 or 4 weeks to get across to the US, and then the US has been taking a couple more weeks to process it. That's that. So the numbers we're seeing here are the effects of what happened a month, 2 months ago in terms of the falls. So if there is those numbers we saw in the manufacturing surveys above, where if all of a sudden things are getting quite bad and they're going to continue to cancel orders and continue to create problems, we're not going to see that for another month, 2 months in terms of these numbers coming through. So there's certainly, though, the shipping issues that we saw seem to be clearing very quickly at the moment, subject to nothing else sort of cropping up. Now, sorry, and I must highlight, though, this is in containers and that side of it. In the energy side, there are still some quite elevated rates, and a lot of that, though, is because what we're seeing is the energy that used to go from Russia across to Europe through a ship, and might only need to spend a couple of weeks on the water to transport it, is now often ending up in India or China, and so those ships need to spend 3, 4, 5 times longer on the water, and so there's a lot more sort of capacity needed, and so the shipping rates we're seeing in the energy sector is not doing anything like what's happening in the containerized side. Right, so that's the shipping side. Semiconductors is one we spoke about before. Look, semiconductors, it is a little difficult to work out exactly what's going on in the semiconductor sector. There's prices in that sector, and talking to companies, you very much notice that they're quite circumspect about the outlook, and we're seeing some quite significant falls in terms of the share prices. And we've started to see some falls in the producer price index, which is a chart I've got up at the moment. There's noting that there's sort of two sides to this chart. On the left is the long term, so just sort of showing to you, well, these prices have been coming down for decades in terms of the prices. So it is, price falls are the norm in this area. And then I've got the very short term one over the last couple of years, and that's on the right. Showing that we've had some quite large price rises over the last year, but those have just started to come off at the top. So maybe this is a sign that it's going into a downturn. Company prices are certainly acting as if it is going into a downturn. There's plenty of reports out there, though, that you can find that are still talking about shortages in the semiconductor space. I think, though, the issue seems to be that the shortages tend to still be in the quite low value chips, the ones that might end up in a car or some of those other productions. So some of those other goods that were, because they're low value chips, nobody really wanted to do them, and it's the higher value chips that are really starting to fall off in terms of the demand. And so what I mean by that is, the chip that winds your window up or down is not a particularly complicated chip compared to the one that can mine Bitcoin or can run your graphics card on your computer is obviously a lot more complicated than simply one that pushes a window up and down. And the ones that have been in shortages of those are the sort of the dumber chips that you've seen from that you've seen there. The other issue sort of overlaid over all this though as well is that we are seeing in the semiconductor space just a lot of money being spent. The US came out with a bunch of tax incentives and targeted plans not that long ago. Sort of they passed into law the CHIPS Act, and a lot of that is about really spending a lot of getting a lot more chip manufacturing in the US and subsidizing and that extra capex is it's likely to have a reasonable effect on keeping prices low. There are also a lot of other countries that are trying to do something on the chip front. India's out trying to do things. Europe's out trying to do things. All about trying to bring that chip manufacturing onshore. And so, I guess in terms of the semiconductors, I'd say these are the potentially signs at the start. When you put them in line, when you line them up with all the other ones I've just shown you, it does look like they're about to roll over and follow everything else. But I guess I just wanted to highlight that this is a little bit of a different sector. It sometimes does march to the beat of its own drum. My expectation is it would fall, but I've got less faith in that than I do in some of the other measures that I've been showing, and there are other things that could crop up. So that's the semiconductor side. The other one then is energy. Now, energy is, we have seen energy prices come off quite substantially. The one I wanted to highlight is Europe, which is sort of the epicenter really of where we're seeing these energy price problems. So I've got a chart up in the energy sector just showing the amount of natural gas imports into Europe over a period of time. So each of the lines is sort of or the dark red line on the left is the key one. That's the 2022, and it's sort of showing from the first week of the year through to now. And then the dotted lines are showing what's the 5-year range been of those. So you can see for the first sort of half of the year, it was running at record highs in terms of the amount of gas that was flowing in. It's now, or not record highs, but highs for over the last 5 years. Whereas now in the last few months or the last few weeks, it's back down to 5-year lows in terms of the amount of gas that's flowing in. So and that's that Putin has been shutting down some of the key gas lines into Europe, and he's been progressively doing that. The issue is he's actually shut down almost all of his imports into Europe, and so the issue is there's not a lot more that he can do in terms of affecting this, or I guess forcing this line lower. On the right is showing the amount of storage. So you can see that goes through that cycle where it builds its way up to a peak and then it runs down over. So it builds its way up to a peak just before winter, and then it runs down over winter. It's at a pretty good spot. It's the inventories are pretty full. You probably expect that they're going to be difficult to fill the inventories much further, given the Russia sort of cut a lot of the gas off. But they are already at levels you'd sort of say are pretty good. The question will come, if it is a cold winter, then there's going to be prices will spike. There's just not enough gas to go around. If it's a mild winter, then you'll probably see some business sort of shutdowns and you'll see some business shutdowns and a lot of I guess pressure and community programs to get people to use less gas themselves. Have shorter showers, turn the thermostat to a lower temperature. Those types of things that can actually make a pretty big difference to the overall amount of gas usage. So I guess I don't want to, I guess I wouldn't want to take a massive bet in either direction on this. I do think the way it is at the moment, it's worth noting that really they need to get through this. They need to get through this period of time in terms of the. It's this winter which is going to be the worst case. I guess that's where I'm coming from. Given Putin's basically shut off almost all the gas already, if they can get through this winter, then by next winter there'll just be more floating storage, and there'll be more regasification plants. There'll be more renewables on, and you go forward, 2 or 3 years, and the amount of money they're spending and effort, they'll probably be fine from there. So we're about to hit the maximum point of pain this winter, and so I guess where I'm getting to is it looks like it's probably going to be okay, but it's now down to the weather as to whether it will be or not.
And Damien, the shortage of gas, is that purely a function of Russia, or are there other factors at play there?
It's Russia. Yeah, it's Russia. Yep. There's, in terms of the demand side, there are some issues in terms of droughts and things like that are causing some issues in terms of factories and production and supply of different things. That's a much less of an issue. If Russia turned its taps back onto full, then there'd be no gas. A lot of the gas problems would go away, and the price would be crushed. So it is worth noting in terms of Russia. Russia can send its oil elsewhere quite easily. Not quite easily, but relatively easily. It takes a lot longer to get the oil from the top of Russia to anywhere else that it needs to go. Primarily India and China. The gas is a lot more difficult though. So if you want to transport gas long distances, you basically either need a pipeline or you need a liquefied natural LNG plants, liquefied natural gas, which basically freezes the gas, puts it on a ship, and then ships it somewhere. There's pretty big question marks on whether Russia actually has the capability of building any more of those LNG plants without Western help. The issue is they take a long time as well to build. So even if they started building some today, it'll be 4 or 5 years probably before they'd actually be able to use those to ship the gas to other places. And then you're back to pipelines, and pipelines take a while to build. I think the pipelines to China, there's been a number of ones sort of built in recent years, and some are still under still being produced. The issue is that I think the Chinese side tends to be built a lot faster than the Russian side. So that, and even still, the amount of volumes, like the amount that Russia has built into Europe, dwarfs the amount that they've built anywhere else. And so it's just going to take time for them to shift gas somewhere else. And given the gas prices at the moment, nobody really wants that gas to be shipped there. So I've got a chart sort of showing the some of the gas prices, in Europe that are still 4 or 5 times higher than what they used to be. And they are coming down, but yeah, still at massive levels and very expensive. So if you're sitting, say, in India, and you're negotiating with Russia about getting on gas, you don't have this burning desire to get out there and buy gas, on long-term contracts at record prices. If they're going to offer you, massive discounts on it, then maybe they'll do it. But it's obviously a lot harder for countries to commit massive amounts of capital to build these pipelines without seeing sort of prices that are I don't know, maybe a tenth of the current levels, at least a fifth of the current levels, probably a tenth of the current levels to actually incentivize it. So Russia's going to have a hard time transferring gas. Much harder than what they will with oil. The final thing I just wanted to touch on was then that sort of comes back to inflation expectations. And so I've got a survey out here from University of Michigan, just sort of showing this is a consumer. And again, that's just that sign that it's very much peaked. It tends to, in the past, once it peaks, it tends to drop very quickly. I would argue there's a pretty good correlation between a lot of these and oil prices. That's sort of one of the things people see at the pump. The price they see at the pump often reflects back on their expectations. But so I guess consumers are these. I guess what I'm saying is these inflation expectations are interesting. I don't think they're something I'd hang my hat on at any one point in time, just because there is this is sort of the sum up, the ground sum of all the individuals, and it's I guess it's very much coloured by recent experience. Has been the best correlation for this line is what was the last so a bit of inflation these people were seeing. So putting that all together, coming back to those two initial scenarios we spoke about, goods demand does very much seem to be reverting back to trend. Supply chain problems. Look, there still are some supply chain problems, and there's potentially issues coming up with droughts and issues in terms of some of the food supply, and high gas prices are certainly causing issues. But a lot of the places we saw all the price pressures from last year have all started to fall away quite quickly. Commodity demand, I didn't speak much about China. There's too much to go into there, but I guess suffice to say, though, the construction is still very, very low in China. And I guess when I'm talking commodities, this is commodities excluding energy. The energy cost side is very uncertain, so they're probably more likely to stay high. It has come back a bit recently, but now we're talking. The real question is being, will higher interest rates sort of drive a recession, which could see then energy prices come down quite quickly. And then the big issue though in energy is how cold is this European winter going to be? And then finally, wage growth. Wage growth quite strong in the US, not as strong elsewhere, and I guess question marks over whether wage growth. If we're going to see sustained inflation, you really do need to see that wage growth come through quite firmly in a number of places, and so that hasn't been the case really outside of the US at the moment.
Excellent. Nice one, Damien. That's some great insight into these leading indicators and what's likely to come. So now we've got our viewer question of the week. So this is for viewers having some discussion in the comment section over the coming days. The question for this week is, which supply chains should we be watching? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So that almost wraps us up. So Damo, thanks again for sharing all your knowledge and your insights. It's really insightful, really valuable.
Thanks, Sam.
Excellent. So we do welcome your feedback on this podcast, especially in regards to future topics. So if you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.